Buddy, Erin Geibel again. I hope you're enjoying your financial training so far. We've talked a lot about numbers. We've seen some new accounting terms. We've talked about some financial documents. And what we want to begin to do now is tie all of these things together to begin to analyze those numbers to see what they're really saying about your company and how they can help you as a manager better understand your company. So what we're going to talk about are some KPI or key performance indicators. And what these are measurable things or ratios that we use to calculate our business objectives to help us identify how well we're meeting those things we said our business is going to do and to see just how productive our business is. So what we'll talk about are 5 main ones. 3 of them relate to the financial health of the company. 2 of them will relate to profitability. And then we'll talk a little bit more about other KPI, key performance indicators, that are out there and discuss some that your company may be interested in, may not be. They're a little more analytical, so they'll be a little more specific to your company's goals or your industry's goals. So let's get right to it.
The first 3 financial key performance indicators we want to take a look at are the current ratio, receivables outstanding, and inventory turnover. All 3 of these ratios deal with the financial health of the company, and they look at the company assets or the good stuff within the company. It'll help you as a manager or an owner understand how well you're using your assets to meet your business objectives. So looking at the first one here, the current ratio, it's calculated by taking your current assets divided by your current liabilities. What this current ratio will help you understand is how well you can cover your debt within your company. If you remember, both the current assets and the current liabilities were the most liquid of the asset and liabilities columns, meaning they'll be able to be converted to cash the soonest, and on the liability side, be due soonest. So when we take a look at Sweet Treats Bakery as an example here, we see their assets and liabilities both on the balance sheet. If you divide the $525,000 of assets divided by the $240,000 of liabilities, get a ratio of 2.19, meaning current assets are more than twice that of the liabilities. So the first thing you're asking yourself is probably, okay, what's a good number for this current ratio? Where should we be? You're always going to want to have assets be higher than liabilities, so a number over than 1 is a given. And a lot of times you're going to want that number even higher than 2. Most financial institutions will require something over 2, because if you think about it, those current assets aren't all cash. That was accounts receivable, that was inventory. So some of your accounts receivable you may really never collect on if a customer doesn't end up paying you your inventory. You may never actually sell some of that, so you can't guarantee that it's going to be $1 someday. So with that in mind, I just wanted to mention there is another ratio out there called the quick ratio, where you do deduct inventory specifically from the calculation and recalculate the number, with the premise that you might not sell all that inventory, so you can't consider it a current asset for the purpose of covering your debt. So Sweet Treats here looks like it can cover its debt. So moving on to the second ratio is our receivables outstanding, and what this is going to tell you is on average how long it takes your company to get the full balance of your accounts receivable. Are your customers paying you timely? It's going to calculate it. You're going to take your accounts receivable divided by your average revenue per day. Accounts receivable, if you remember, was on the balance sheet again under the current assets. And your average revenue per day, you're going to look at income statement. If you remember, both of the balance sheet and income statements we used for Sweet Treats were monthly. So to get the per day, you take that total revenue number and divide it by 30 days there in the month of June. The result is 39 days. It takes the bakery about 39 days to get all of their money owed from customers. Is this a good thing or not? Are they collecting timely? If you think about the standard invoice terms, it's usually somewhere around 30 days. and companies will often push the limits on those, and some do pay late. So your average, really industry-wide and business-wide, let's say, is probably over 30. Some industries it's going to be a lot more, some industries it's going to be less. So 39 seems to be a standard there, somewhere in the middle. However, if I was the owner or manager of this bakery, I'm going to question that 39 days, because if a lot of my sales are immediate over-the-counter transactions, then that's money instantaneously. There's nothing owed to me. 39 days would seem to be a lot. However, maybe I sell through a larger grocery store on credit, or maybe I do a lot of catering and I allow credit customers for that. So knowing your business and understanding your business is going to make a lot more sense of these ratios than just taking some average standard number generalized out there on the internet somewhere. The third KPI is your inventory turnover. And what this is going to help you understand is how many times you go through your inventory in the period of a year. It's calculated by taking your annual cost of goods sold divided by your average inventory. You'll notice both of those numbers in the calculation aren't straight from either the balance sheet or the income statement. There's a little extra calculation to coming up with them, but don't be scared. It's simple. So you look at your cost of goods sold from the income statement and just add them all up for all your months of the year to get your annual cost of goods sold. Your average inventory, you look at the balance sheet and just add up all your inventories for each month and divide it by 12. For our bakery here, they have about $1.5 million annual cost of goods sold. On average, came up with a $172,000 of inventory. Looking at the month of June there, 160 was their number, so that they had a little less inventory than normal in that month. Anyway, the result is 9. They go through their entire inventory 9 times a year. Again, we want to ask ourselves, are inventory levels accurate? Is 9 a good thing? It depends on your industry. Again, as a bakery, you probably want to sell fresh goods, which means I'd expect anyway, to be going through inventory multiple times a month. 9, at the level of 9, they're not even going through everything once a month. So that may suggest inventory is too high. That could be too many raw materials on hand. That could be finished products going bad before they're sold. That might be holding some sort of product nobody really wants. So as the manager, I'm going to look into that and either reduce my inventory or possibly change a product to generate better sales and less stale inventory. The next two ratios are related to profitability. You'll notice as we calculate them that they're rather similar in calculating, but they'll tell us slightly different concepts or something slightly different. And the difference between the two ratios will also help us understand a little bit about our business and our profit. So your net profit margin, that's going to tell you how much of each dollar sold you're keeping within your company. What percent of all the dollars coming in are you actually keeping? And to calculate this, you simply take the bottom number of your income statement and divide it by the top number. The bakery here is making 11% on every dollar sold. So for every dollar revenue in, they keep 11 cents. Again, you want to think about, is this good or is that bad? Are they making a lot, working hard and only keeping 11 cents? Again, I'll tell you out there, there's some companies that are happy with 3%. If they're selling high volumes of cheaper things, 3 is going to add up. Others expect over 20%. If they only sell a couple things at a higher price. So again, it depends on your goals as a company, what industry you're in, where you expect to be, whether that number of 11 or whatever yours works out to be makes sense or not. Gross profit margin along the same lines, same calculation almost here, except you take your gross profit divided by your revenue. And if you remember, your gross profit was that profit related directly to your product or service. So Sweet Treats Bakery here was $80,000, and that was their revenue minus all of the ingredients and direct expenses to their cookies to their product they're selling. Revenue was still the same, and calculated out here is 38%. So while they made 11% in total, they're actually making quite a bit more, 38% on just their product. Again, I can't answer directly if that's a good number or not. You want to look at what your product is, or where you expect it to be, or do you have your costs as low as you could? Have you worked out materials pricing with your suppliers? Do you have waste? That's going to clue you into whether your percentage is good or not. Another thing to think about when we look at these two ratios is the difference. If they're making 38 cents on every dollar directly from their product, but only 11 after all the overhead and marketing and sales costs, your indirect expenses, what makes up that difference? Is there too much waste within those costs or not to go from 38 to 11? That could seem like a lot. However, maybe this company is right now focusing on marketing, so they've ramped up their spending there, or maybe they're hiring a lot of new people at this point in time, so their training costs are high, their turnover. There could be reasons, and the point of looking at these numbers is not just to calculate them, but to understand and to analyze them. Why are the numbers the way they are? And as more importantly, I guess, even is where do you expect them to be? What are your objectives? What is your business goal here to do to get those numbers where you're comfortable with them?
So now that we've talked about 5 main financial KPIs, I'd like to take the time to discuss some of the other KPI or metrics that are out there that'll be a little more individualized for your company goals. But there are a ton. There's a whole world of metrics out there and things you could track. What you'll first need to do is identify, what is your company's focus? What are the main things you want to look at as related to money, dollars? But right now we can go through a couple of them. Customer metrics, those are a biggie. How much does it cost you to get a new customer? How much does it cost you to retain a customer? What's the difference? Is it more expensive to do one versus the other? And what's the value added of these things? Customers are always a big topic. If you find the market, you want to keep it. Or, maybe you really don't. Maybe you want to find some new customers because they are costing you a lot. Other metrics are your cost control metrics. Look at how much labor dollar is costing per sales. How much are you spending on your people per each one of your sales? Could be high, could be low. But if people and labor is your focus, that's something you could look at. Or you could also look at your sales dollar per individual employee. How many people does it take to make that dollar? You could look at your overhead, your overhead dollars per sales, similar to labor dollars per sales. Just seeing how much overhead you spend to make each additional sales dollar. You could do that with any of your expenses, really. What does that cost you to make an additional dollar of sales? On the flip side, you could look at your sales per customer. Do you have a lot of customers with few sales dollars each, or do you have 1, 2, 3 big customers that you make most of your money from? Just a lot of different things you could track to understand where your costs are and if you aren't controlling them. On the operational side, you could look at operational quality or efficiency metrics, some of these being order processing time. How long does it take you to complete that order, to fill it from the time you get it to the time it goes back out? If efficiency is your focus, that's something you want to look at. If quality is your focus, you could look at defect amount. You could calculate how many defects per good product you have. So many things out there, so many metrics, so many things you could track or want to track. Most importantly, you'd want to identify what your company is looking at, what your company needs to best run, your focus, your mission, your goals, and make sure these metrics are in line with those. You don't want to go off, deep in metrics and numbers and calculations if they don't really mean anything to what your business is focusing on. Then again, you don't want to do the opposite and calculate nothing. Think you're doing great, think you're running along with these high dollar customers, making a ton of money off of them, but then they're really costing you for what reason? More money than you're really profiting from them. So again, there's 5 main financial metrics or KPI we really do encourage you to focus on, but then to branch out and to look at your goals, look at your objectives, and determine some other KPI that are out there. I'm more than happy to answer questions and discuss these with you, but again, they'll be more individualized based on what your company and what your specific goals are.